look at the markets, and the markets were closed early on Friday, just a half day, but ended in the green, fortunately, and of course, over 4,000 on the S&P 500, and that's been an interesting ride. You'll remember that at the beginning of this year, we traded as high as 4,800 on the S&P, but as low as in the 3,000. So we're kind of in the middle, Derek, and we're going to have to see how we end the rest of the year.
Right. I mean, typically the seasonality would suggest we would rally into year end. However, in bear market years, that's not as pronounced as it is in other conditions in terms of monetary policy and the rest. And, you know, the cardinal thing is don't fight the Fed. And the Fed is continuing to tighten. They're going to raise rates again in December, probably 50 basis points. That's the Fed funds rate. But they're also reducing their balance sheet, and that takes liquidity out of the marketplace. So we expect volatility to remain higher than what we're accustomed to. We think there are going to be great opportunities. And ultimately, when the Fed does finally pivot and cut rates, that's when the market really can run.
So let's talk about this. That term is probably you're going to hear a lot of that in 23. And the term, air quotes right now, folks, pivot is a long ways away. So what we expect is what, in air quotes here, folks, is pause, right? So do they go through into early 2023 and look at the data and begin to pause the rate increases? That's what we're going to look for. So 50 basis points in December. We'll see what the Fed sees in early 23, and then perhaps they just stand aside and watch how higher interest rates get digested.
And what's really amazing, the strength of the labor market, the strength of the U.S. economy, the Atlanta Fed is currently thinking that fourth quarter GDP could be up 3% in real terms. So this is not a recession by any means. So the Fed has a lot of room to raise rates higher in order to stifle demand, which hopefully will bring down inflation in the long run.
And let me just try to clean that up, because you say in any measure. So we did have two back-to-back quarters, and a lot of economists will certainly argue the fact that that is the technical definition, and that's what we had earlier in 2022. As we go into 23 and these interest rate hikes begin to kick in, we largely expect a major slowdown in the second half of next year.
All you have to do is talk to a friend of yours who's a realtor. They'll tell you things are softening.
No doubt.
And that is the wealth effect, right? The reverse wealth effect. Your house price goes down a little bit. Your stock portfolio goes down a little bit. Maybe you don't spend as much on that vacation, or maybe you don't take a vacation at all. So that's what the Fed is trying to do, because these inflationary pressures do tend to persist for longer than people expect.
And of course, we all know this is a story has been beat to death. Interesting, Derek, is earlier this week I was paging through some notes, and I found the notes from 1 year ago, and this is exactly what we were talking about. We were talking about the Fed has been too accommodative. They have put too much fuel into the fire, and now they're going to have to walk it back, and they haven't been able to do that quite yet. But we knew this more than a year ago, long before they even began to start with their rate increases in March of this year. So at the end of 2021 and early 22, they were still pouring it in, and so it's going to take a while for this to take effect.
Right, and monetary policy, and they know this, it operates with a lag. It takes some time. People get adjusted to certain conditions. We have also the potential of a railroad strike. I mean, we have distillate fuel, diesel fuel trading at ridiculous prices, shortages potentially during the winter. We all hope something happens positive out of Ukraine and Russia. But again, there's so many different things, and that's why, when I think about what we do well, it's tactical investing. We take advantage of opportunities when they exist, and we rotate based on what we think is going to go on in the future.
And that's a defensive strategy, folks, that he's talking about. So having a balanced portfolio, and around the outside of that balanced portfolio, do you overweight or underweight particular sectors or ideas or strategies? And that's what Derek is talking about. And that really is just the basic part of asset allocation and diversifying your portfolio, which is a basic defensive technique that we employ.
Dave, you mentioned your notes from a year ago. Can I see your notes from this week? I'd like to know what happens in a year.
Yeah, exactly. We'll have to watch that. And of course, folks, that is really why we put this out, is so people understand there are things to do in times like this.